Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thank you for checking out the Private Lenders Podcast. Today we are talking about new construction. We're talking about ground up construction lending. It is part of our industry in the private hard money world. Not a huge part of it really. We've always done it on the side, carefully, kind of like we do everything else. Everyone in the mastermind's always given us a hard time because of how conservatively we lend. But honestly, guys, that's from experience. That's from being in this game almost 18 years now. Thousands of loans that we've done, managed hundreds of defaults. That's why we lend the way we do, honestly, because we know how the numbers play out. Most of our states where we lend are judicial foreclosure states. And we just know how defaults play out. And we are in the business of not losing money. And if anything, we want our defaults to make some extra money. And so keep that in mind as we break down how we underwrite and how we fund ground up construction.
Yeah, and the reason we don't do a ton of them is because, like Chris said, we're pretty conservative on them. So we'd like to do a lot of them, and we would do a lot more of them if they work. You know, it ends up that a lot of the new construction and ground up construction deals we're doing are borrowers that already own the land free and clear, and they just need construction money. So then we can hop in. So let's talk about some of the risks. So typically we can categorize these things as there's three things to really look out for. So number one is your day one exposure. Now, what do I mean by that? Just like we always talk about, most people don't have an after repair value problem. They have an as is value problem. You know, after the property is done and completed on the market, there's tons of equity, right? Like usually that's the case. So it's safe. The problem is day one. So let's say somebody's buying a vacant lot for $100,000 and it needs $250,000 in new construction costs. And it's worth, so you have $350 in costs. And let's say it's worth $500. They can flip that thing afterwards, sell it for $500. Well, after the building and the house is built, you're great. You got $150,000 in equity. Whatever that percentage comes out to be, it's almost 35% equity, 35% equity cushion. You're good. Your issue is your day one exposure. Because if you're doing a loan of $350, if you're doing a loan of $100 for the purchase price, $250 for the construction costs or the build costs, you have a $350,000 loan with a $250,000 construction escrow, construction holdback. So in essence, $100,000 is your day one exposure. Well, if they're buying it for $100,000 and you're lending them $100,000 towards your purchase, you have zero equity built into that thing. And I don't know about you, but I don't really want to take back a vacant lot. That's not, not something I really want to do. You can't unload a vacant lot as quickly as potentially a regular house or a regular property. So, and in general, I would say you want to be at a lower LTV day one on a lot than potentially a house. So you got to be careful on that. So we'll talk about that a little bit. We're going to talk about the second biggest risk, which is execution. How many people do you know that you've lent to that can build a house? Yeah, they can have contractor. Obviously, they're going to have, a contractor, GCs, things like that involved. But can they execute? Can they pick the right one? Do they know do they know how to handle a project? Do they have the cash to, in essence, cover reserves if you need to? There's lots of different things that you have to look out for. So the execution is obviously important. And I'm going to add another risk. So that's the second risk. The third risk is the type of lot that it is that they're building on. Do you have to do site work or is it an infill lot, right? I was talking to someone earlier today and they're thinking about lending on a piece of land, but it was a house that's just getting torn down. It already has public water, public sewer, utilities run, stuff like that. Public utility lines run to that. So they're just tearing down the house and then rebuilding a new house. But what happens if this ground up construction project is, a vacant lot and they have to do site work? And you got to figure out if it's on public water or public sewer or private or well water and things like that. Then you got to run, or what happens if it's a subdivision and they haven't subdivided it? The difference between raw land and an infill lot that's ready to build is a big, big difference. So you got to think about that as well. That's obviously important. And then the fourth big risk to take into consideration is the price of the lot as is, right? Because I'll give you an example. Let's say somebody's buying, you're in an area and the cost of a infill lot's like $50,000. Like that's what somebody's buying it for. Like you almost can't give any value consideration to that land, right? Because let's say somebody's willing to put like 50% down. It's like, okay, cool. So I have $25,000 loan on a $50,000 lot. That's someone, who knows how much equity you really have or how much percentage or dollar sign. Like there's just risk in that. Now, let's say you're in a high, priced area, New York, Washington, D.C., Dallas, whatever, California, something like that. And you're buying a lot for $500,000 and it's an infill lot. Like I would say a 50 LTV deal on that is way less risky, right? Partially because there's that much more equity room, but more importantly, the borrower is bringing $250,000 to the table in that scenario than the $25,000 on a $50,000 lot. And I think most people listening to this or watching this, when they're thinking ground up construction, I'm not talking about the higher end stuff in California and stuff. Like I think they're talking, hey, I can buy a lot for 20 grand, 40 grand, 50 grand, 100 grand, 150 grand. And those are the ones that I think have the most risk.
Yeah. Also, I want to get into the next phase of it. Like when we are talking to a borrower, say it's someone we've lent to before, we know they're experienced, they've done some ground up stuff, even if we didn't finance it, that we can track down and, take a look at how the job went. How are we going to structure that? Because this one is going to stand out to some people as being a little unusual, and it is. In essence, making a ground up construction for us very, very similar to a rehab loan. You want to break that down for everyone?
Yeah, so I think there's a few different scenarios based on the situation and how much cash they're going to bring in and the price of the lot and the cost of construction. But like in general, if there's real value to the lot, so let's say it's like a $500,000 lot and a $500,000 build, right? I think you can be more aggressive on something like that. When I say more aggressive, I'm not talking like 80% of purchase, 100% of construction. I'm talking 50% of purchase and 100% of construction up to like that's max, right? And that, by doing that, that borrower is bringing $250,000 down plus closing costs. So your exposure is only $250,000 on day one on a $500,000 lot. So in essence, a deal like that would be like a $750,000 loan, $500,000 holdback. Your exposure is $250,000 up front, and then you draw out in multiple draws the $500,000. I think in that case, that could be realistic. Now, a lot of the deals that we do, like we talked about, were just, it's either refinance on free and clear lots or just no consideration for the land whatsoever. So like, let's say somebody's buying a property for, and this is like a standard kind of ground up construction deal that we would do in a lot of the areas. Let's call it a $400,000 or $500,000 ARV. They're buying the lot for, let's call it 100 grand, and it needs $250,000 in renovations and in costs to build. What we would probably do is say, hey, listen, we're not going to give you we're not going to use any consideration towards that land. And you need to get through the framing phase and under roof before we're even going to give you your first draw. So let's say they're buying it for 100 grand. It needs $250,000 in work. Again, right? We would structure that as probably a $250,000 loan with a $250,000 holdback. So we'd have no exposure day one at all. The borrower would bring $100,000 to the table plus closing costs, and then they would start the work out of pocket. So this could be if the property is an infill lot or if it needs site work, right? That's up to them. We have zero exposure, right? We did $250,000 loan with a $250,000 holdback. Like, if we're net, like, there's nothing to even fund to the title company. There's zero. We have $250,000 set aside for them to get their renovations done. So what happens is they go in, they get the site work done, call it, if there is any site work. They put a foundation in place or they put a basement in place. And then as they are framing, they start framing the house, they put a roof on it, right? It doesn't have to be completely finished, but the framing for the most part is done. Then we come in and we start doing our draw schedule. And the beauty of that is technically it's just like a big, heavy rehab loan.
And how many borrowers, I don't know if we have an actual percentage on this, but how many people go for this setup?
I mean, I think the ones that know that it's hard to get a construction loan, either they qualify or they don't qualify for a construction loan, or like they don't really have the option, and like they have the cash to make it work. They'd rather go this route. This is an easy, to be honest. If they have the cash, this is a way easier route than a bank. Now, yes, sometimes you can get a bank construction loan and you don't have to pay interest on the construction funds and the undraw funds. We do in our case. So if we do a loan with a 250 holdback or $250,000 loan with $250,000 holdback, they're paying interest and fees on that 250 from the beginning. So like they better be ready to get that thing moving quickly so they can get their funds drawn to them. So there's that kind of one thing to think about. But like our draws are quick. We'll get that thing done. We'll fund that thing quick and we'll get those draws done just as quick as any rehab draw. 1 day or 2 days. Banks are not doing it that quick. And you know what? A bank's draw process, if they do a $100,000 loan on $1 million property or a $900,000 loan on $1 million property, their draw process is the freaking same. They do the inspection, they go through a committee. Was this done, this done, this done? Oh, you missed this. We're going to dock $1,000. Nobody cares about a few $1,000 here and there on an inspection draw. If you structure these things and the borrower is so heavily vested on the front end and you're structuring these deals, accordingly, so you're safe, like I'm not going to sweat $1,000 or $2,000. And during our scripting on the front end, we'll talk to the borrowers about that. Be like, this can be a very easy process for you. Yeah, you're going to need to bring a good amount of money to the table, but like it's going to be an easy process. And to be honest, most real estate investors that are looking to do a new construction loan, ground up construction, and they're looking to borrow $250,000, say, and they need $100,000 plus cost at the table. Like it's not unreasonable. Like they're not going to go out there and find a no money down ground up construction loan. That's certainly not happening, and there's more risk in that, and they know that. So we've done quite a bit of these over the years. I don't know how many for sure, but like it happens, and we do more of them if they're structured like that. I mean, I'm always talking to someone in our pipeline, always on a regular basis, and quoting a deal like this to someone. And pretty much the difference is like, do I want to use HMB and have to put $100,000 down plus get this thing under roof? Or do I want to go through the process of my local bank or maybe an institutional backed capital partner that has this and go through the headaches to bring less money to the table? And then that's up to them of what they decide.
Yeah, I'm not part of the conversations that happen at the time of origination and underwriting. Like I only see these deals once they hit the pipeline, meaning they're locked up with the borrower, terms are agreed on, they pay the deposit, sign the term sheet and all that stuff. And then I take a look and we talk about them because we're discussing our deals frequently. And I'm like, I remember one in particular in New Jersey. It was like, oh, it's 325 minus 325, like 325,000 held in construction. I was like, okay, we have zero exposure. They went to closing and then they paid the fees and everything else and all the stuff to title dispersed to us. And that was that. We just took our funding and put it right in the trust balance during post-closing process. Not to get too nitty gritty here, but it's an interesting type of deal to be a part of because they're probably going to be fine. We're underwriting the borrower to, check their experience and financials, all the normal stuff. It's probably going to work out. But there's, the stuff that you mentioned, like, permitting, anything under the ground, site work, like the kind of stuff that we may or may not be experts at. And the same with the borrower, right? But we're going to be hanging out in the background, keeping an eye on the job. And then once it gets to the right point, we can come in with our draw schedule. And until then, we have zero exposure. So if the job were to go completely sideways for some unforeseen reason, we don't have any risk. And that's an interesting place to be and pretty advantageous for a first mortgage lender.
Yeah. And that's the point, because I'll talk to lenders. They'll be like, well, I don't really have experience with this and I don't structure it. I'm not 100% like, how they get, do they have to do architecture drawings? Do I have to do this? Do I have to do that? And I'm like, I don't fully know. And if you structure these the right way, it doesn't really matter that much. Now, obviously, throughout the construction process, the draws, you want to make sure they have permits in place. But it ends up being the same as a rehab loan at the end of the day, with like almost less risk if you set it up. Because the reason that there's somewhat less risk is, if you ask a new construction home builder what's less risky, that or flipping houses? They're always going to say new construction is less risky. And the reason it's scary for people that don't know the business, but new construction home builders will always say it's less risky because it's a blank slate. Like blank canvas. It's like, this is what's going to happen. It's the same thing, rinse and repeat everywhere. When you're flipping a house, there's a lot of unknowns. As soon as you start opening up the walls, you just don't know. You're dealing with, right, 1940s piping instead of 2025, standard electrical and piping and plumbing stuff. So anyways, it's this could be a good niche for a lot of folks if you structure them the right way. And I wouldn't be afraid if you're in a market, and I've talked to lots of lenders out there that are in markets that, borrowers are buying these properties for $25,000 and there's $200,000 cost to build. They're small, 1,500 square foot properties. That's okay. Like if you're buying this property for if somebody's buying a property for 25 grand and it needs 200 in work, like they're not just bringing 25 grand to the table. You can structure that same deal at maybe $125,000 construction holdback with $125,000 or $125,000 loan with $125,000 holdback, where in essence, they just need to do more work before you get to that point. You always want to make sure the borrowers have enough skin cash into the deal. They're either bringing it to closing or they're fronting work ahead of time before you come in with your draw schedule. And then you might say, well, what happens if I'm underfunded? Well, you're not going to be underfunded because you have zero exposure on the front end and you don't start your draw schedule until they've completed a certain amount of work. That might be 50% of the project. You might be like, hey, after you drywall this project, I'll come in and I'll fund the rest. You make the rules. You set it up how you want to do it. You want to make sure they have enough skin in the deal. And then it turns more into a rehab deal. And I know there's a lot of naysayers out there, like, oh, I don't get deals like that. That wouldn't happen. No one's going to go for that. Well, maybe not. We do them. And a lot of other lenders in our mastermind group structure them this exact same way. So if you want to get in the game the responsible way, then do it this way. Like, this is a good way to be able to get, ground up construction loans to add them to your portfolio, but do them responsibly.
All right, guys, that is the pod for today. That is the low risk way to get into ground up construction. If that's what you're looking to do, we appreciate you checking out the show. If you haven't done so already, if you are curious about working with us in person, go check out hardmoneymastermind.com, click on live events, schedule a time to talk to Dave Bauer. We'll see everyone here next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.